In this video, I will give you a review of Chapter 3. More specifically, I'm going to introduce more consolidation entries, which are subsequent to the date of acquisition. So on the date of acquisition, we already introduced two consolidation entries, entry S and entry A. I also showed you the worksheet that we use to consolidate the parent company and subsidiary company's book. Alright, so on the worksheet, the parent's investment account is eliminated, so that's the purpose of those consolidation entries. So the subsidiaries' actual asset and the liabilities can be consolidated. So we need to use subsidiaries' actual assets and liabilities total fair value. Okay, and then subsequent to the date of acquisition, in other words, probably at the end of the period after the acquisition, there are some adjustments need to be made, like amortization or depreciation that's related to the assets or the liabilities that have a different fair value from book value. So there would be some adjustment we need to make. And we also need to remove any inter-entity transactions like accounts payable and accounts receivable between these two companies. And also, the parent company is going to accrue the subsidiary income on its book. It has to be removed as well. But we remove the accrued income from the parent's income statement. At the same time, we need to combine their revenues and expense together. Okay, so the consolidation is required for external financial reporting, and parents will select an investment account method to monitor its activity of the subsidiary, and there are three methods we're going to introduce. Focus will be on the equity method, but there are two methods. There are two other methods. One is initial value method, the other one is the partial equity method. You also should focus on what's the difference among these three methods and make sure that you know at least one of them well. Okay, so let's move on to this example directly. So here's the example. Prepare consolidated financial statement subsequent to acquisition when parent has applied equity method in its internal records. So here I'm going to introduce the equity method. What's going to be the consolidated entries with this if the parent use this method to maintain its investment account. Alright, so parent company obtains all of the outstanding common stock of some company on January 1st, 2020. Parent acquires this stock for 800,000 in cash, and some company balances are shown below. Okay, so those are the information related to the some company. Here, some company is the subsidiary, and we have the book value, have the fair value, and for some accounts, their fair value is different from book value. Then we create a third column is about their difference. And okay, so first let's move on a little bit. And remember, in last chapter, we introduced this acquisition date allocation, how we allocate the acquisition date subsidiary fair value to those accounts with different fair value from book value. So we're going to review that one more time. So the total consideration transferred by the parent company is 800,000. This is the total cash. So this is the 800,000 cash. That's the total cash paid. And next column is what is the book value of the subsidiary they acquired. The total is 600,000. So there are two ways to calculate book value of a subsidiary. One is to calculate what's the total of their equity account balance, which is 600,000. Another method is to use the total identified asset minus total identified liabilities. So that's based on accounting equation, asset minus liability equals to those equity. So that's two ways to calculate that. Okay, so that's 600,000 already calculated here. Okay, so the fair value minus, so the excess amount of fair value of the consideration over book value is 200,000 equals to 800,000 minus 600,000, that's 200,000. Next, we are going to allocate this 200,000 to those accounts with different fair value from book value. If we look at this table, notice that the trademarks, which is undervalued by 20,000, So it's fair value 220, book value 200, so undervalued by 20. Second one is patented technology, undervalued by 130,000. And equipment actually is overvalued by 30,000, so there's a negative. Liabilities, there's no difference, which means that is fair value equals to book value. So we are going to allocate this excess 200,000 to these three accounts. First, allocate 20,000 to trademark, 130,000 to patent technology, but we need to take 30,000 from equipment because that is the overhead, that is the overvalued. In other words, actually, so the calculation is to use 200,000 minus 20,000 minus 100,000, 130,000, and then minus negative 30,000. Okay, and then we get 80,000 left, and that's a positive number. And this left positive amount or the debit amount goes to goodwill. Well, if they get a negative number here, then that will go to the gain on bargain purchase. Okay, so that's how we allocate allocation day subsidiary fair value to those accounts. And then let's continue to introduce something new. So after we allocate this acquisition day subsidiary fair value, and then we need to prepare this excess amortization schedule. In other words, if this trademark is undervalued, then every year there should be additional amortization to be recognized. And okay, so for example, for trademark, 20,000, but because it have indefinite life, so which means that we do not amortize it. Well, second one, patent technology, undervalued about 130. That's 130, and it has a 10-year useful life. So then for this excess amount, every year there is going to be additional $13,000 annual amortization. Well, for the equipment, it's overvalued by 30,000, 5 remaining useful life, and every year we need to add back 6,000. Okay, goodwill, we normally do not amortize goodwill. Okay, so the total annual amortization is 7,000 equal to 13,000 and minus 6,000. So this is the total excess annual amortization expense we need to adjust. And the equity method. Next, let me give you some more information related to this acquisition. So after acquisition and in the following year, assume some company, the subsidiary earned 100,000. So this is the net income reported by the subsidiary, and 40,000 dividend also paid by the subsidiary on August 1st and paid on August 8th. Alright, so when the subsidiary company have those income and declare and pay dividend, so with equity method, the subsidiary, the parent company is going to reckon it on its book. So first, as to the first, on January 1st of 2020, this is the acquisition date. When the parent acquired some company, and this is the first journal entry they created to debit investment in some company and credit cash. Okay, so this is the journal entry to actually establish this investment account, and this is the equals to the total consideration transferred, 800,000. All right, and then on August 1st of the year, when dividend is received, and that's the parent company is going to debit dividend receivable, at the same time credit investment in some company. So it's like assume that you are the parent, whenever there's dividends paid, it's going to reduce your equity balance, right? So it's just dividend is received, then we'll debit the cash and credit dividends receivable. Okay, and then let's move on. And then when it goes to the end of the period, and after the some company report its earnings, and this earnings is going to be recognized on the investment account. So assume you are the owner of a company, so this earnings is going to increase your equity account, right? So we are going to debit investment and credit equity in subsidiary earnings of the investment earnings. At the same time, this investment earnings will be for this 7,000. That this is the annual asset amortization. This is adjustment. We need to recognize this expense on our book, and this expense is going to reduce the equity account. So we debit 7,000. That's going to reduce this equity in subsidiary earnings, and then credit investment account. So that's can have an opposite impact on the subsidiaries earnings, and also have an opposite impact on the investment account. And this is the parent and subsidiaries financial statement at the end of the year, and we need to use consolidated entries to combine them together. So more specifically, we're going to use the entries to remove this investment account, because when we combine them together, then this investment account should not be there. At the same time, we're going to take care of the subsidiaries equity account, and then also we need to adjust some of those balance sheet account if they have a different fair value from book value. Remember, all the numbers here are kind of adjusted based on their book values, but we need to make some adjustment to make it equal to fair value. And also there's something else, equity in subsidiary earnings. So this is like investment income, and we will combine them together, and this need to be removed as well. And also for the dividend declared by the subsidiary, this is like inter-entity transaction, similar to this investment earnings. This need to be removed as well. Alright, so let me introduce those entries one by one. The first one is entry S, which already introduced in chapter 2. Entry S is to eliminate subsidiaries beginning stockholder equity account. So journal entry is to debit common stock, additional paid-in capital, retained earnings, and then credit investment account. So that should be the account over here. Be this 3 account. Common stock, additional paid-in capital. Well, for retained earnings, we need to remove its beginning balance. So at the beginning of period, its retained earnings is 380,000. The reason we do not take care of the annual balance is because we are going to that's going to be taken care of by this by subsidiaries income balance. Okay, so next one is entry A. Entry A is to adjust subsidiaries balance from its book value to the acquisition date fair value, and so based on this schedule, so which means we need to use this schedule. So that's some information here. Okay, so we are going to use something over here. So we debit those undervalued assets, so like trademark, patent technology, and recognize goodwill, and credit overvalued equipment, and then the difference is going to use this plug-in number. So the difference goes to this investment account. Okay, so we have investment account on the credit side in both entries. So this entry S actually remove the book value of the investment account, and then entry A is to remove this difference between fair value and book value. Okay, so next entry is entry I. So this is the new entry. Entry I is to remove the inter-entity incomes. So the total amount is 93,000. How I get this amount? So it's actually equals to the reported income 100,000. So we actually the amount is 93,000. How we get 93,000 is equal to some companies reported earnings, and then minus the 7,000 excess annual amortization here. Because we are using equity method, so we use a fully accrued accounting. So this 93,000 equal to 100,000 minus 7,000. 100,000 minus 7,000. Okay, so that's entry I. Entry I to remove SANS income recognized. Okay, so we have 3 more consolidated entries. Entry I. Entry I is to remove SANS income or the subsidiaries income recognized by the parent during the year. And entry D is to remove the intra-entity transfer of cash for dividends. And let's go back to the journal entries that parent company recognized during the year. Okay, so we introduce those entries during the year. So for when the dividend is declared and parent company recognize this journal entry, so we use entry D to reverse this one. So a debit investment in some company and credit dividend. So that's the consolidated entry D to reverse this transaction. And as to the transaction I, is to reverse this intra-entity investment income. So here for the income, we are going to debit equity income and credit investment in some company. Okay, so that's D and I. Basically, we reverse the parent has done during the period. In other words, we're going to remove this balance and at the same time remove this 40,000 as well from the dividend declared by the subsidiary company. And the next one is the consolidation entry E. Consolidation entry E is to recognize current year excess amortization expense, which is prepared in this schedule. Okay, so I already prepared that in this schedule. So basically, we're going to recognize those excess annual amortization related to patent technology and equipment. Okay, that's the entry E. So I have the debit amortization expense related to patent technology, and then depreciation related to equipment. The reason we credit depreciation is because equipment is overvalued. Alright, so then let's move on to see what it looks like in the worksheet. So this is the complete worksheet using equity method. So we have entry I's to eliminate the subsidiary equity account. Entry A is to adjust those balance sheet account to fair value. And entry I is to eliminate this subsidiary earnings. Entry D is to remove the dividend paid by subsidiary company. And then last one, entry E, is to adjust for those excess annual amortization expenses. Okay, so this is the equity method, and there are two other methods. Let me go over here. Okay, so we introduce equity method, then there's the initial value method, there's a partial equity method, and let's compare them side by side. Okay, entry S and entry A. For entry S and A, initial value method and the partial equity method are all the same as equity method. Then move on to entry I. Entry I is to remove the intra-entity income, and as the three methods are different. Okay, so in equity method, we are going to eliminate this accrued income. Well, in initial value method, the income recognized on the parent board is actually the dividend declared. In other words, parent company consider the dividend as their income, so we use entry I to eliminate actually the dividend. Well, in partial equity method, the equity income is not, so the accrued amount of equity income is only the equity income, and there's no adjustment. In other words, in equity method, there is the annual excess amortization is already it needs to be adjusted here. While in partial equity method, there's no annual excess amortization adjustment. Okay, so in other words, all three methods have different entry I. Next one, entry D. Entry D, equity method and partial equity method, they are the same, but for initial value method, because dividends are already been taken care of in entry I, so there's no entry in initial value method. And next one is entry E. Entry E is to adjust for those annual amortization. So all three methods have the same, are the same. In other words, okay. In other words, entry I is the entry that all three methods are different from each other. Entry D, for entry D, equity method and partial equity method are the same, but initial value method do not need this entry. Okay, so that's for the that's the year during the acquisition, anytime during the acquisition, and anytime following the year of acquisition. Let me go through that. there is going to be a entry star C required for initial value method and partial active method. In other words, they need to make adjustment to adjust their investment account to what it's going to be in equity method. There's no entry required. There's no entry star C required for equity method. Okay, we're going to go talk more about this, the amount here in a minute. And then we're going to still have the SAIDE. And for all of them, they're kind of the same as their prior year. So like same as initial year. But they're just make sure, yeah, kind of the same. But for the A, just make sure that it's not the same as equity method, but not the same as initial year. So we are going to, so the new balance for those accounts will be the unamortized excess fair value. In other words, after 1 year of amortization, then the amount here in the second year would be a little bit smaller than the first year or the first period. Okay, as to this entry star C, so how we get that amount? You can use those problem solving videos to have a practice. I'm going to use these tables just to give you a brief review of where that difference comes from. If the parent use equity method, so in its return earnings, it's going to include the subsidiaries earning just for this amortization expense. Okay, so in total, this is like 309. Well, if a company uses partial equity method, then it only accrued the income, but there's no adjustment. So it's going to record larger equity income in its return earnings, in the parent return earnings. While if the company use initial value method, then dividend received, the received dividend is considered as their equity income from a subsidiary. They didn't recognize those equity income, should not kind of recognize that. So it's quite different from other two methods. This is actually the dividend income. Okay, so you see that with different methods, the parent company is going to have different return earnings, and that's the other account we need to adjust. So in this country C, entry C, we're going to have two accounts to adjust. One is return earnings, the other one is the investment. And this is where the difference coming from.